Good morning and happy PCE day. It is your favorite market host, Max Pitts, and let's talk about the Fed's favorite inflation gauge that just hit the wires, and it's sending mixed signals. Personal income is down, spending is down, but inflation is still sticky. Let's break down the May PCE report and why it matters and what it really means for rate cuts. So buckle up and let's go. So, here's the Bureau of Economic Analysis report that just dropped. Personal income fell 0.4% in May. Disposable personal income, that's what you actually get to spend, fell 0.6%. Personal spending, aka PCE, fell 0.1%. Real disposable income, adjusting for inflation, dropped 0.7%. And real PCE, actual consumption after inflation, dropped 0.3%. The translation of all this, people are making less, keeping less, and spending less. That's a slowdown, plain and simple. That's the easiest way to read this data. Don't look more into it than that. Now, inflation is a bit sticky. So let's talk prices. The Fed's obsession. Headline PCE rose 0.1% month over month, which is in line with expectations. However, core PCE, excluding food and energy, rose 0.2% month over month. On an annual basis, headline PCE clocked in at 2.3% year over year, while core was at 2.7% year over year. So, what's the takeaway? Inflation is still above the Fed's 2% target, but it's not running wild. It's what you'd call annoyingly sticky, not raging, however. So, we could see some upside in SPY today. This may not be a tank day. However, why is this even on Powell's radar? Isn't the guy going to get fired? Just kidding. But seriously, the Fed wants to see a clear path back to 2%. They've been saying this time and time again before it starts cutting rates. Today's numbers, well, spending is softening, incomes are dropping, but prices aren't falling fast enough. That basically puts the Fed in the wait and see mode. They'll love seeing spending cool off, but they'll hate that core inflation is still sticky at 2.7%. Now, what does this mean for stocks, bonds, and your wallet exactly? The market will love the slowdown in spending. It hints the Fed could cut later this year, but the sticky core PCE, that's going to keep a lid on rate cut hopes for the July meeting. Expect rate cut bets to shift more towards September or even December if inflation doesn't cool faster by August. So here's the big picture. Consumers are tapping out, fewer dollars, weaker spending. Inflation is cooling, but slowly. The Fed, stuck in the middle, waiting for something to break finally. If you're trading this week, watch yields. If the bond market smells a legit slowdown, you'll see rates move lower. That's when risk assets, cryptos, and real estate might catch a tailwind. All right, trades and gainers. What do you think? Is this enough for Powell to finally pivot, or are we stuck in the higher for longer pain cave? Drop your take in the comments, long or short. And don't forget to hit that like button, subscribe, and smash the bell so you never miss these fast macro breakdowns. I'll see you on the next one. Have a great morning. Or actually, I'll see you in the live show in about 8 minutes. So have a good one.